What's up, everybody? It's John Barr with Prime Homes bringing you your monthly market update for here in San Antonio. Got some exciting stuff that we're going to be looking at here that has not happened in the last several years, actually, that I want to show you and kind of show what the results that I got this month. It's pretty interesting and it's going to be good for real estate to see, especially real estate investors, on what happened. So we'll go ahead and get into this. So your March overview on the numbers, your sales price was 234,040, which was only a 2.02% increase year over year. Now, if you guys have been watching this consistently the last couple months since we started this, we were seeing much higher increases year over year. We were seeing 6, 7, 8, 9% increases year over year, which was something that was been pretty consistent. But this month we only went 2.02, so it seems like it kind of slowed down a little bit. Median in sales price 187,625, which is only a 2% increase year over year. Again, lower than it traditionally has been. Total sales 1,954, which is 3.4% increase year over year. Average rental price 1,394, which is 6.5% increase year over year, which is a lot higher than it normally is. So if you look at the last months, we were trickling about the 2, 3, 4%, and now the rents have really started to increase and the prices have dropped, which is kind of something that is interesting to me. Employment still a few months behind according to the Bureau of Labor Statistics, so we are just over 1.1 million, which is a 2.32% increase year over year. Unemployment has gone up again this month, and we are, I think, in the third or fourth month where the the unemployment has increased. We're up to 4.16, which is a 2.22% increase year over year. Increase from the previous month. Now, it's really interesting. It's kind of wondering what's going on as we are employing more people than month over month, but it seems like we're getting a lot of people that are moving here and claiming unemployment. We're just not creating jobs fast enough. So is that a problem? Who really knows? But it's unsustainable for a long period of time before our unemployment starts getting too high and we just don't have enough jobs that are going to really start pulling down on unemployment. Months of inventory was 3.56, which is a 0.85% decrease from the previous month, which is to be expected as we move here into these hotter months and when real estate really starts to move. It's kind of interesting to watch, and I'll explain here on the next slide that we're having the months of inventory really go down, because you can see here what I'm talking about is what has not happened previously, as we did not surpass last month's medium sale increase. So you're looking at December here, then January, February, and March. We dropped back down. When you look at these previous years, we don't have stuff like that. We have basically, here's your December, January, February, March going up here. We never really had it drop back down and start heading back down when you're getting into the March time frames. So it shows that, hey, the hot real estate market that's continuing to be going up, has shown a little signs of weakness this last month. So it's going to be something that we are going to continue to watch here, Prime, to see if we're continuing flattening out, if there was just a kind of a not as many people bought as many high-priced homes, or if inventory is just really dumping off, to see what happens. But it's interesting to see the months of inventory dropping, but the price not increasing like it traditionally has the last several years. So I'm expecting some kind of a flat plateau correction or something like that, because you can count here. We got 1, 2, 3, 4, 5. We're heading into our 6th year when your typical cycles are 3 to 5 years. So it's going to be interesting and something we're going to continue to watch. Monthly rents are holding strong and they're continuing to go up. Now, one thing in a down market, a lot more people prefer to rent because they are scared of falling real estate prices, not as many people hiring. Credit isn't as easily available to buy homes, so people start to rent. And like we're seeing that 6.5% year over year increase in the monthly rent says there's a lot of people really trying to rent here. So that's another thing that we're going to continue to watch and try to understand what's going on in the market right now. 20-year unemployment. Now remember, this graph is reversed. As it gets higher, that's bad. So we're talking 7% unemployment here. And now you can see the last couple bubbles. We got the stock market, or not stock market, .com bubble here, then the real estate bubble here. And what I usually look for is how long do we bounce around here on the bottom before we continue to go up. And if you look at the last time between the .com and housing bubble, It only lasted about a year or so before it started to kind of climb back up once it hit its bottom. And we've been bouncing around here for an extended period of time, and we are continuing to go back up, and we have hit several peaks and now heading back into our third peak with unemployment rising. So we're going to continue to watch that as well and see what happens. So now the biggest thing I always get, so where do I market to find my best leads? So for us and what we do at Prime, where we try to look at is where is inventory moving the fastest and where is the highest demand amongst regions of zip codes and price ranges. So we go by price range. You can see here now months of inventory is speed at which inventory is being consumed. So if you talk to an appraiser and ask them, say, hey, how do you determine when to raise prices? Well, they don't say months of inventory, but they see, well, let's see how many houses are available, how fast they're moving, and is there upward pressure that's kind of saying, hey, people are willing to pay higher prices to live in this area. So you can kind of see here now, balance market is about 6 months. That's a balance market between buyers and sellers. Anytime we drop below 6 months, that's when it's starting to move into a strong seller's market like we are now, which is the 3.5 months. So you can see in San Antonio, once you get to about this 250 above price range, those months of inventory really start to climb up. So this, if you're doing a lot of fix and flips and you're trying to sell houses, that's important because that's holding costs. If you've got a house that you're paying $3,000 a month in interest on a $400,000 hard money loan, 7 months is a long time to be holding that and paying that interest rate, because it's really going to start cutting into your bottom line. So it's something to really kind of keep in mind when you're flipping these houses, looking for these price range. I know everybody wants to go these big high-end fix and flips because that's the most profit, but risk increases with the higher profit, and here is the reason why, because there is a lot of choices for people looking in those price ranges on the city as a whole. Now that's not saying that there are pockets where months of inventory is low in those areas, but throughout the entire city, if somebody's looking for that price range, they can move around the city and find a lot of different homes that they can choose from and maybe negotiate better prices. So the next one we do is by zip code, and it's no surprise where's the best zip codes. You're seeing every one of these besides one below the $250,000 mark. So a lot of these are your 150 sub 200s, where we do a lot of our work at Prime is in those price ranges because they move. And if you are a real estate agent and or work with a realtor and you try to put in an offer at below that 200, below that 150 mark, you don't have much negotiating power, which means there's a lot of people trying to buy homes in there, and it's pushing those prices up. So every one of these zip codes as a whole is below 2 months of inventory. So that means in these zip codes, prices are continuing to rise and are going to be until the pressure kind of relieves off these and these numbers start rising. So now where's the worst area? Same thing. Where's the highest month's inventory? It's where these higher price ranges are. All except for, let's see, we got one here and just barely under 250, but the majority of them are in that 250 plus of where the highest months of inventory are. So like we said, that is holding costs. So if you're flipping in these higher ranges, really know your numbers and take that into account when you go to sell. What's on the market? How many houses are for sale? How many have sold the last month? And work those numbers into each other to see how much inventory there is in that specific area. And then might tell you, do I need to go above and beyond the normal flip to make that mine the best one so you can get the quickest sale? So I know last month I kind of went into the foreclosures, the numbers and stuff. I kind of lost my access just right as I was making this video, so I am going to work to get that back hopefully next month. If not, we'll kind of work something out. But it's something we really going to kind of watch, and I'm very interested in, being who I am and like looking at numbers and data, to see those sales prices drop when inventories or the median sales price drop with the rise in unemployment. So that's something we're going to continue to watch to see if does that show, hey, we're going to have kind of a correction or prices are going to plateau, and kind of see what's going on in this current real estate market. So now if you guys have any questions, please feel free to reach out to me at my email address down here at John@PRYME Homes. I'd be more than happy to answer any questions and check us out on Facebook, like our Facebook page. And in this email, I've now started including the PDF of these slides so you can go back and reference each slide as far as the months of inventory. So you guys have a great month, and we'll see you at the next newsletter.